coming to our event, and thank you for showing up. And now we have today we have Mr. Martin Gray and Steve Hinch to talk about investment, and with our topic here, approaching storm, where do we go from here? We have two speakers. Stephen Hinch, as I've said, he's from MBMG, and he's just joined us 2 months ago. He's a senior advisor and one of our analysts, MBMG group. And then later on, we'll have Martin Gray from Myton Optimal. He will be providing us with his insights into today's topic. So, can we call on Stephen? And if you have any questions later, we will give you time to ask your questions.
Have to come down when we're a little bit shorter than everybody else. Yeah, my name is Stephen, and look, I'm the warm-up act today, so I've got about 5 minutes in which to try to explain the reality, or shed a little bit of light onto the reality of what's happening with growth in the global marketplace, and some of the disparities that we see between real growth and with the inflationary pressures that the different governments, such as in the United States, the United Kingdom, and now in Japan, are trying to put to help reinflate their economies with what is called quantitative easing, but is obviously just massive printing of money. So within just a few slides, I'm just going to try to highlight a few facts about economic growth, or lack of economic growth, within the global marketplace, and some of the disparity we see with what is happening with quantitative easing, and certainly it ties in with the keynote address that we're going to see from Martin about the approaching storm and where can we go from here. This first chart that I'm putting up, because I've only got a short time, I'm just going to take kind of a helicopter view. And what we're looking at here is the manufacturing index, which is the blue line that we see. This is the Purchasing Managers Index, so it's manufacturing growth or lack of growth across the global marketplace. And the yellow line that we can see is the US inflation expectation as based by the financial market, so it's a forward-looking indicator. What we can see happening up until 2010, that the manufacturing index, or the PMI, was actually expanding. Now, when you have an expanding manufacturing index, that obviously has some upward inflationary pressures, and I should say that some inflation is good. So as you would expect, the US inflation expectation was coming up in line with the manufacturers index. And in 2010, when the manufacturing index started to soften, and it started to soften and go back downwards, and we have a very sensitive little touch screen here. Because that is somewhat deflationary, then as you would expect, then the US inflation expectations declined along with that. Now that's how it actually should work. What happened at the end of 2012, when the US Fed dramatically increased their quantitative easing and started basically printing in the range of $82 billion a month to churn into the marketplace to try to reinflate the economy, because what they had been doing before was apparently not working. What we see here is a complete divergence of the two different factors. You've got the deflationary pressures of global manufacturing. Even though it turned up slightly, you can see the trend is still downwards. So you've got deflationary pressures still in place, but on the other side, because of $82 billion a month being pumped into the market, you can see the market expectations for inflation growth is actually going up. So at this one point in time, we're actually having these two indicators starting to separate, and the expectations of inflation getting ahead of the reality of the deflationary pressures that are still in the marketplace. The point of this chart is to show that at the moment we're at potentially a critical turning point in the global markets. What that turning point is, good or bad, or an increase in more quantitative easing, only time will tell. But we are in a critical turning point. This thing is getting more ahead of me than my thoughts. to go back one. Okay. This next chart that I have here is just showing a comparison to put it into more of a highlight. The top chart we've already seen, which is the Global Manufacturing Index. We can see that that has been declining since 2010. Now that is a Purchasing Managers Index, so it's an assumption of purchasing managers on what is happening going forward. The second chart below it is actually industrial production. Now that's actual output. And what you can see from that chart is that industrial production has been declining rapidly with no response to quantitative easing, and it's been doing so since 2010 in line with the Purchasing Managers Index. So what it is showing that it is still really core deflationary pressures around the world because economic growth is continuing to shrink. So we have these deflationary pressures still in place. One final chart to have a look at from a global perspective. This is, to me, an indicator of what's happening in the supply chain. This is average fleet speed. So it's basically a calculation of cargo movements around the world. And what you can see from 2009 to the current period in 2013, that this average fleet speed graph, you try to say that quickly, the average fleet speed graph has actually declined by 30%. Now that does not mean that cargo ships are on a go-slow strike because they don't like quantitative easing, and it doesn't mean they've reverted back to sail because they can no longer afford petroleum. It means that global production, or the flow of global goods around the world, has declined by about 30%. So on the one hand, you've got manufacturing is slowing, and your supply chain has also reduced in line with that. Now, this is one reason why every time the International Monetary Fund comes out and revises their projections for global growth, it is always revised downwards. We've very seldom lately seen a revision upwards on what is happening with global growth. So what I want to do is have a very quick snapshot look at two of the biggest players in the marketplace, the United States, China, and Japan. There's a myriad of indicators you can look at in the United States, but the one that I like to look at, because I'm taking a helicopter view, is this one indicator, which is capacity utilization. Now all of that means is, in this chart, it is making reference to the percentage of GDP producing output within an economy compared to the potential output that exists. Again, to put that in simple terms, if you've got 100 people that can actually go out and dig a hole, but only 50 of them are digging because you cannot afford to hire the other 50, you got 50% capacity. What we can see, and more worrying for any analyst, when you look at the long-term trend in the United States, and this goes back to the 60s, we can see that every peak after a recession, every time the economy grows or is reinvigorated, each following economic peak is lower than the previous one, with just one exception where in 1995 there was a slight double dip top and then it followed on downwards. What this is saying is that the United States is not a healthy economy that is showing great vigor and great possibilities of continuing to grow. What it is suggesting that the United States is actually a mature, aging economy that every time it rebounds, it actually struggles to get back to the point that was at in the previous economic growth period. In fact, this chart suggests that unless the US is able to actually reinvent itself somehow, it may well have a problem even getting up to 80% utilization within that marketplace. And just one more point on this, if you look at the dip in this last recession that started in 2008, it dipped down to utilization to levels that has never been seen before, at least since the 1960s. In fact, the current high point, which is around 76%, is similar to the low points of the 60s and the early 70s. So there has to be some kind of a real reinvigoration of what's going on in the United States. The next one I want to have a look at very quickly is the Chinese economy. And the reason for this is obviously China is often quoted as being the new engine room of growth in the global marketplace. And lots of comments around the fact that China is now slowly declining to around about 7% GDP growth, which almost any other country in the world would love to have 7% GDP growth. But if you think that this is coming off probably the last 2 decades, where China has been going from double-digit growths and slowly declining to 10%, 9%, 8%, and now 7% as their forecast GDP growth. So I did just see on the news this morning that the Bank of China has actually revised that up to 8.2%, so they're being a bit more aggressive. But what this one chart tells, again, is a horizontal, a helicopter view of what's happening within this marketplace. Over the last couple of decades, most of China's economic growth has been based on internal factors. So those internal factors would be internal infrastructure, manufacturing. So what we can see here quite clearly that in roughly 2009, 2010, the economic engines that were being used, the economic growth consumption of electricity and internal rail cargo movements peaked in early 2010, and they have been in decline ever since. Now what this is saying, or at least suggesting, is that the money that's being spent internally on construction and new manufacturing plants has been declining rapidly. And in fact, I'm sure you've all heard of the stories of many miles or kilometers of uncompleted or even completed highways that don't go anywhere, and they have a lot of shopping malls and office complexes that are still unoccupied. For a period, this actually created millions of jobs in China, which was very important, and it created a massive new middle class, which must be a concern for China if their economy is declining and less jobs growth is taking place. What will happen to that middle class? So this is a very important factor. China is part of the global growth engine, and just one slide. I said I was only going to talk about 3 major economies, but one quick slide. Had to be real quick because it's disappeared. Is the Chinese growth compared to Australian impact? And the reason I say this is because my boss Paul put himself on the hot seat many times over the past month, talking about the dangers in the Australian economy and what we could see happening to the Australian dollar. So this one chart really shows a very close correlation with what's happening in China is happening in Australia, because Australia is a net exporter of most of their products, and one of the major ones are the products that China needs for their internal infrastructure, so their iron ore and other supporting products around that. So this is not just a correlation, it's a complete match with what is happening in China is having a dramatic impact on what's happening in Australia. There you go. And in fact, I think the Aussie dollar was down to 0.67 this morning. Sorry, other way around, 0.97. So it's come down quite considerably from where it was on the highs. The final chart that I want to have a look at on the global marketplace is the Japanese government. Japan is a country that's had the better part of 20 years of deflation. I was telling Paul the other day, I remember when I left the United States when I was working for Lehman Brothers, I think then the Japanese market was up around 23 or 24,000, and it just collapsed overnight, and it's never really gone back anywhere near those historical highs. The reason I'm showing this one chart is because Japan is perhaps the first of the countries that have initiated quantitative easing where it's going to backfire on them, and apparently is backfiring at the moment, and could potentially create what some economists call a crack up, which simply means that when the Japanese government initiated their massive buyback of bonds in the marketplace, it was the equivalent of $62 billion a month, US dollars a month, that they were printing. The basis of that was to debase the value of the yen, give them a bit of a competitive position in the marketplace. An unexpected reaction to that has been a massive spike in Japanese bonds. So what that says is that the marketplace itself, the financial marketplace, is pricing in massive inflation probably kicking back into Japan, remembering that they already have about 250% debt to GDP, low employment growth, negative to no GDP growth. So there is a reaction in the Japanese market that hasn't been seen in the US or the UK at the moment. And this could well be, we'll say, a forewarning of what may well happen in the United States and the UK if they even think they need to start increasing the size of their quantitative easing. So that is all the time I have. But I do want to wrap it up because it's a gloomy outlook, but I have to say, we know that the health of the global economy requires extreme caution. Even in good times it does. You have to be careful of what you're doing. But we also believe that as we move out of what is currently an economic winter with more late winter storms on the horizon, the next 2 or 3 decades that follow this, whenever that might be, could well be the most rewarding for investors. And I have to caveat that by saying, as long as you know where you are, you know where you're going, and you're strategically prepared with the right asset allocation. And on that note, I can hand over to Martin, because he is going to be talking about asset allocation. But before I do that, I do need to read my introduction of Martin, because whilst I know all the other stuff, I had to write notes on this. I'm going to introduce Martin, and then we're going to flick over, and unless Heidi can run over and change the presentations. Martin Gray, who's our keynote speaker and guest speaker today, as you all know, is from Miton Optimal. Now, Miton are fund managers that not only want to help clients make money, but they also want to manage the downside risk, which is probably more important now than it's ever been. So in other words, capital preservation is more important, or just as important, as making money. Now, Martin is the lead manager of the strategic and special situations portfolios, and has been with Miton Optimal since 1994, and took control of that company in 1997. And I hope you don't mind me adding this part, Martin, but Martin's career in fund management started back in 1979. So that makes him a young fellow. What makes Miton somewhat different from other managers is its belief in asset allocation being the key to long-term outperformance of the market. Now, often the view that Miton Optimal has been taking is going to be contrary to what many others may believe in the markets as a result of their macro market research. So they're very forward-looking. So it does take the approach and believes that inefficiencies exist between markets, and these can be exploited as economies move through different stages in their cycles. So with that said, I'm going to introduce you and hand you over to Martin, and hopefully this doesn't jump ahead of you like it was for me. That's your forward button.